there is big reason not to be in cash, right? Because your cash losing by at least 2% every year compounding. It's not important to know which one is what. I just call them treasuries, and that's
You
about
should
it.
know these things.
Yeah, right. Here's what I subscribe to, and I'll explain why. I don't follow a lot of people, and I don't have that many followers. I used to have quite a bit, but that's my profile. And let's see who I'm following and why. I usually follow people who are either very knowledgeable traders, like legit traders, not just talking shit about trading, but more like they actually put in trades, they post screenshots, you can see if they're doing good or bad, and they have reasoning behind their trades, explain it, and so forth. And there is something to learn from. Then I have some famous figures here. For example, CZ is here, this guy, Jurian. Yeah, all of them have this bios here. So he's some head in Fidelity, which is one of the biggest funds out there. Not funds,
Okay.
but platforms for investments,
Mm-hmm.
kind of like Charles Schwab and so forth. Then there are some CEOs and stuff for different companies. Most of them, then there are lawyers in crypto space. There are some congressmen and such. So I usually focus on those who create stuff, those who trade stuff, and those who impact policies for specifically crypto these days. So, for example, Sheila, she's a CEO of Crypto Council, as you can see, and she used to be some sort of position in IMF. So she have quite a bit of knowledge in the field and connections. So it's nice to see her being in pro crypto space with the connections she inherited from her old hat she was wearing, the title she was having. Yeah, there are some more developers, some analysts, and usually analysts is interesting because half of them are wrong, half of them are right. Therefore, you kind of have to pick side who you think you should follow rather than just blindly follow.
Right.
And some of these I follow for a while, so I can kind of I develop my perception of them, whether they legit or not, or they just trying to pump themselves in one way or another. So I like Balaji. He's more like a tech philosopher type of thing. He used to be a CTO of Coinbase. And yeah, there are some people from different foundations. Yeah, again, heads of companies. So not a lot of people, like 80, I believe, of them, but it's a mix of lawyers, heads of big companies, developers, and policymakers type of thing, hedge funds managers and such. So either good traders, good into trading, or important in policymaking, or some sophisticated developer background. And yeah, it's not many. If you look at other people, they're full of lists like thousands. Yeah, I only have 80. I don't like to have a lot of noise. So whenever something pops up on my feed that I know it's something usually meaningful.
Okay.
Uh, I mean, I'm not gonna talk about followers per se because it's not really relevant. It's not
Yeah.
important for our conversation. So I'm gonna stop sharing this part. Any questions about Twitter?
No.
Okay, how I use it, right? So whenever something pops up, how do I look at it? Obviously, the first use case is news developments, what happens in the world. So it's a really good way to find out real time if something happened or there is even glimpse of something that happened. Like you're gonna find out on Twitter first before you're gonna find out on TV or wherever else. And whether I react to any of that, not really. Usually I don't react to a lot of it. I just kind of archive it in my head that something happened, and I try to kind of have build my perception of the world, where it's moving and how it's developing over time, so that I'm, I guess, understanding reality or immediate future with better clarity. So instead of somebody on TV chew me his or her opinion about something, I look at what seems to be what happened and make my own opinion.
Mhm.
So yeah, I usually don't react in any way. Like I don't use it for trading per se. I typically don't trade frequently, but I kind of accumulate whenever I have a thesis in my head, what I think is happening or where I think things going. These are the inputs for me to create that point of view.
Okay.
Okay, we can talk about relationship between news, price, and the timeline. Um, and also, I guess we can talk about bots, because there are algorithms created and deployed out there that react to news. Uh, how that might look like. So, for example, again on Twitter, so somewhere bots would follow somebody famous like Elon Musk, and whenever he is saying something like positive or negative about something, bots would analyze the message and try to trade in specific fashion, try to fortran manual traders, for example. So let's say if Elon would say something like, I believe Tesla gonna be even better next year, then bots might, for example, I mean, that's just hypothetical algorithm. Bots might buy real quick trades, shares of Tesla before the crowd gonna start buying shares of Tesla. So they're gonna front run and then sell them those shares in some time. So there are bots like that, and they focus on stocks, on crypto, on anything. And sometimes news is not legit, and those bots would trigger some sort of market behavior, and it becomes volatile. But main piece that is important to keep in mind, and something I talked about before, I think with episode with Max, is that news should not be really your trigger for action. It
Mhm.
may be trigger for action for like long-term vision, but it shouldn't be like, oh my God, like today I need to enter this trade because XYZ happened. Usually once it happens, it's already quite a bit of move that took place, and you are chasing the reaction for that news. Usually market is first to show you that there is some changes happening, and then an hour, a day, or week, or months later, you start to see, oh, I see why market reversed, because this and this was impacting it. So price behavior is going first, news going second, usually, and like it, especially in the bigger trends. So you might see a lot of negativity. Like a good example would be like a war in Ukraine, perhaps. You see, oh, on the news, on TV, everything seems to be worse and worse and worse. Yet you start seeing that S&P start going higher. So then you're like, oh, that's kind of logically incorrelated. But then months later, you start seeing, oh, there are different type of aspects, different news that are maybe more positive now. But market realized that things became very negative too far, so it started to buy in stock market at discount, assuming there will be positive change in the near future. So don't dictate market what it should do. Market knows better, usually ahead of time. Um, the timeline is important. So you might have those news induced bots that trigger different volatility, and then there are larger trends that are more like transformational, something that would last for years. Perhaps good examples would be like gold going up for like 5-10 years, commodities going up for 5-10 years, something like big shifts. For example, good example would be if we switch in towards electrical vehicles, then prices for commodities start to go up for long periods of time ahead of time, because there is increased need for lithium and other metals that used in batteries, for example. So all of that needs to be taken in account when we create a plan and when we act upon that plan.
Mhm.
Anything that you want to talk about or in more detail?
I guess just overall, like, our conversations have been about finances. Whether I know I have a lot to learn in regards to crypto. Um, I guess just timelines. I just need to concentrate on timelines and trying to decide which other options do I have, like, to invest my money. Do I just do like high yield savings, or do I continue putting some funds towards my 401k? Do I pull out that money? Like, that's something else that I need to decide.
Right. Yeah, then one thing that we talked about is future of dollar. Therefore, it's going to impact 401k future. And you know my point of view. And I developed that point of view quite a while ago, like maybe 10 years ago. Like I just don't see how within time frame of, I don't know, 50 years or so, roughly speaking, how the world going to be as predictable so that you can just assume whatever you accumulate there in dollar terms, in dollars, going to be there waiting for you. Like imagine 50 years, how many wars going to happen? How many countries going to show up and disappear on the map? President's going to be elected. Like there is so much that can go wrong that I just don't believe money going to be there. In fact, I don't think even some countries going to be there in 50 years, right? So I think I
Do we
take
want to
more
be here in 50 years?
I think I take more proactive approach as far as finances. So what I can do myself or today, rather than what this model of 401k gonna do for me over a long period of time. But that's just my point of view. And a lot of people go by traditional route, which is having that either IRA or 401k, and they might be actively managing it or they use somebody to advise them. So that's the typical route. I'd say probably most of people have it. I just early on developed the idea that it's not for me for some reason. Not for some reason, for specific reason.
Yeah, I was gonna say you do have a reason.
uh, yeah. And then something I wanted to mention. So how would you approach the decision making, right? You mentioned savings account, you mentioned yields that they can provide hypothetically. How would you start moving closer to decision? What's the thought process would be for that? I guess the idea of yield versus risk versus how much money you want to make potentially, right?
Mm-hmm.
How fast? What would be the success criteria when you know, like, okay, so I derive to a point of time in my decision process that I'm comfortable to pull a trigger in one way or another.
I guess we've talked about this several times, like for crypto, our main goal will be, of course, to make money.
Mm-hmm.
I, I just need to learn that's not going to be overnight. I need to learn, I need to be patient, and I need to have a timeline, a long-term timeline.
Mm-hmm.
I'm still like, I'm ready to invest and we are going to invest, but at the same time, it's like, I need to be okay if I lose all that money. So with that being said, I know that I need to have some savings. Like, that's just me. I need to have some security. Um, with a high yield savings, I mean, I know I'm not gonna make that much. I look at the accounts, and the most percentage that I was able to find, it was like 3%. But I know that money is gonna be there. Well, hopefully, because you are getting me scared with the dollar thing.
Even bank thing. Dollar is one vector of attack. Second is bank itself. Like say if they go into bankruptcy procedure of some sort, well, you're gonna be alone in line waiting for your turn to get what's left out of them.
And then with the 401k, I mean, I just haven't really taken the time to look into it because, like I said, that is just brand new to me. I didn't work in big corporate before, so now that I'm able to have 401k, I need to look into how to manage it and use it, not just for the money to sit there. And I know after a year they start matching, or whatever amount I put in there, they match the same amount.
That's the thing I like about 401k. If employer matches you, then you basically have free money per se. But even better if when you have HSA account, health savings account. I mean, it's not a lot of money that you can put in. I think it's capped at like $5,000 per year, but your employer can match you on that as well. So you're getting basically free cash every year that you can use for healthy stuff. I mean, that's not a lot of money, so not even probably worthwhile talking about it. So safety.
So as a final advice, or what would be your advice?
If I would be in your position and given the criteria that you described, so given your risk profile, I would put maybe for your position, I would say maybe like 30% in crypto and approach it like you described it. It can go to zero and so be it, but it also can go, I don't know, 20-fold in next 10 years. You want to open yourself up for high potential one way or another, whether it's a business, stocks, crypto, and whatever, something that can just grow exponentially, and then assess the probability of that growth and risk of that potential growth, right? Because your downside is zero. Then if your upside is, I don't know, 5, 10, 20-fold over some period of time, so that's good risk to take. Let's say the chances, I mean, hypothetically 50-50. It's okay. You're going to lose one time. You're going to make one time, but you're going to make 20-fold or something. So then it's great bet, statistically speaking. So back to how would I do in your position, in your situation, I would do about probably 30% up to 30% in crypto. And we can talk specifically about what would be our selection, for example. And then, majority probably would be in cash until perhaps some sort of good market situation on real estate where I would buy something cheap. For example, hypothetically, if housing market crashes for at least 20-30% for whatever reason within next time frame that we're talking about, then I would have cash to jump on a mortgage perhaps for discounted compared to current prices, housing of some sort, because that is a hard asset as people call it, so it stays valuable and desirable, and property rights are still solid in the United States and a lot of Western countries, so it's not going to disappear or being taken away from you. So yeah, basically invest that and keep the rest in high yield savings. I mean, you can also choose, instead of high yield savings, you can choose invest into like treasuries or something, because roughly speaking, it's the same thing. The risk profile, I think, roughly the same. If dollar have problems, then Treasury is going to have problems. But at least Treasuries pays you higher yield. So there you can get 4 to 5% if you, I think, put into market fund of some sort, rather than having it in bank savings account where you have risk not only dollar but also bank, where market fund is risk is basically dollar system by itself, and that's it. There is no real bank. There is a platform that sells you security, but security is actually issued by government. So you have only one risk, I would say. That's my perception. I had never traded money market funds, and I have never bought outright treasuries before. Also, so for people who may not understand, there are different terms that may be used: bond, treasuries, T-bills, and notes. All of these are treasuries. The reason they have different names is their maturity: 2 years, 10 years, and 30 years. I think 2 years called notes or T-bills, and then one of the other called 10 years, and then I think bonds are called for 30 year. That's, I think, what I remember. It's not important to know which one is what. I just call them treasuries, and that's
You
about
should
it.
know these things.
Yeah, right. If I go for bar exam of some sort for certification, that's probably matter. Okay, so yeah, these are the options. And then I think the other option could be municipal bonds, which is debt certificates issued by municipalities like City of Dallas or County of King County or whatever. So these are more localized entities, government entities, state entities that are looking to get funds from citizens, and they pay some sort of coupon, some sort of return. And what's good about those, a lot of times if you buy, I think, locally, so let's say if you live in Texas, you buy Texas-based issued municipal bond, the returns on that bond, your profits are tax-free, at least for the state. On the state income tax, I'm not sure about federal income tax. It probably doesn't matter much for people who live in Texas, but let's say if you live in New York and you don't have to pay tax, New York tax on your income from municipal bonds, then it's advantage. But unlike federal level, municipalities cannot really issue their own currency, right? At least not as of now. So if they go bankrupt for whatever reason, like let's say City of Detroit, I think went bankrupt like 10 years ago, they don't really have a way to print money to compensate you if they in trouble, where federal can print as much dollars as they need to compensate you for the treasuries. Like right now we're talking about raising debt ceiling, and what it really means is that they know they have deficit for the budget and they know they need more money, so they just issue more debt, and there is always a buyer for the debt. At the very minimum, it's a Fed. If there is no existing capital that can purchase that debt, then there is always Fed that can purchase and inject new capital in the system. So municipalities cannot do that. But historically speaking, it used to be times in history where local municipalities have their own currencies. So, for example, I was in a museum of money in Lisbon in Portugal, and it was interesting because at some point in the history, I don't remember which century, doesn't really matter, but because they were so low on capital, they would issue their own currency. Like, let's say City of Dallas have its own currency and so forth, and they would print their own currency, and then you would have like 20, 30 different currencies, even though you live in the same country, and
Wow.
it becomes messy. But it's important to understand the reason behind that. It's a lack of capital that can be deployed for some sort of budget needs or infrastructure development needs. So they start to create these gimmicky schemes in order to find that funds. So it's not a good place to be. Or let's say if taxes are raised, if government entities are raising taxes, that means they have big holes in the budget that they need to fill in, and they can fill in two ways: borrow more or have larger tax receivables from citizens, like property tax, business tax, and so forth.
Mhm.
The other way to go about it is lower expenses, but typically governments don't go in the direction of lowering expenses. There's a phrase I've picked up recently, says the only most permanent program is the government's temporary program. Meaning, when a government says this is temporary, that means it's going to be there forever.
Mhm.
So,
I mean,
I
not
guess
even.
that's kind of what I
I'm
would
like, not
do.
even myself. I don't want to lower my expenses.
You're right, yeah.
I want to
And
make more money.
especially them.
I
So
want
there
to
is a
make more money instead of lower.
interesting rationale behind why they don't do that. Because let's say you're a politician, let's say you run a campaign that, hey, I'm going to fight for teachers, I'm going to fight for these type of rights and these type of benefits for certain group of demographic. Once you're in power and once you're about to get reelected, for example, you either have to deviate and now you have to have some sort of new slogan, or, and you're going to be probably called liar at the end, or you do that or try to do that, but for that you need money, so then you need to find that money somewhere. So it's either move it from one stream of income to another stream of expense, or print money. Basically, politicians usually would choose to print money over not delivering on promises, because then they lose power. And not so we can reasonably be sure that's going to be money printed indefinitely. It's just a matter of pace. And the reason, by the way, you've heard about 2% target inflation, right? So on TV, on Bloomberg, and Fed usually would say something like, hey, we are trying to lower inflation to the target rate of 2%.
Mhm.
Question, why is 2%? Because they know, because of their money printer, because of their structure of their budget and debt, they know there is continuous need for more money injection in the system so that they keep the system running. So basically, your money supply increases by at least 2% every year, and then it compounds. And there are statistics out there that something like in the last, since like 70s or whatever, the purchasing power of dollar decreased by like 90% because it all compounds. So not only it's 2 plus 2 plus 2 every year, it is 2% on 2% of previous year. So you have the keep on increasing spectrum. Knowing that, there is big reason not to be in cash, right? Because your cash losing by at least 2% every year, compounding. Therefore, you want to be in assets of some sort that either grow or not diluted by printing, right? So that's why a lot of people like real estate, because I mean, it's more obvious, it's physical, and it's one house today is still one house tomorrow, although the roof might be need to be replaced. But if you hold cash, even though you put it in savings, you fight in that 2% inflation. So let's say if you just mentioned that the highest you found a yield on savings account 3.5 minus that 2% that we target, then you realistically have real return of 1.5 or 1%. And in current situation, we don't even have that. We have negative return because inflation is currently at something like 5%. So you actually negative 2% or so if you have high yield savings account. And if you don't, if you just have cash on the checking account, then you just simply lose on average 5%.
Mhm.
And yeah, one thing about inflation we talked about is that it's not broad. It's not all baskets of goods and services that inflate by same amount of percent. It's some of them inflate more, some of them even deflate. But on average, statistically speaking, it's 5%. Like each spectrum, each sector have weight in that formula, like energy, housing, goods and services, leisure and stuff. And I think they give to energy one of the biggest weight in that formula. So if, like, let's say gas prices come down from $100 per barrel to like 71 right now, drop about 30%. That's why we have inflation drop from like 8 to about 5 right now. So in similar terms, I think last time we didn't talk about that phrase that you saw on the wallet, right? Remember, Exodus Wallet was saying, hey, here's a backup phrase you want to take care of. Do you remember that?
Yes.
So what
I
is
mean,
that?
I know, yeah, it was asking me to back up. Yes.
Yeah. So what is that seed phrase? So it is a sequence of words anywhere between 12 to 24. And each word represents a certain number of characters, some digits and letters and digits. But it is presented to you in a human readable form, words. So then you have 24 or 12 words. That's how long the string of characters will be for your private key. So effectively, that string of words is the private key that we talked about, right? We have address in the cloud, and we use private key to have access to that funds, right? So whenever they say back up your seed phrase, that's what it is. Basically, write down that private key somewhere or save it somehow, that if you lose this phone, or if you need to recover access on a different device, different wallet, you can type in and restore existing connection using that seed phrase. Therefore, you should keep that seed phrase private, and as soon as someone get a hold of that seed phrase, you basically have a high risk of losing those funds because they have unlimited access to that address in the cloud. And especially so if you use that hierarchical wallets, the one that can hold multiple cryptos at once, and it uses this kind of master seed phrase. So that means you can give access to all the variety of different coins that you have for different addresses, always one seed phrase. So even more risk. Let's say hypothetically you hold Bitcoin and Ethereum in one HD wallet. So you have one seed phrase for two types of tokens, two types of coins. Both of them can be compromised if you lose that seed phrase. If someone have access to that seed phrase, it's okay for you to lose it as long as nobody finds it, right? It's only when people find it and start using it, that's when you have a risk of losing those funds. It's like someone found your debit card and they know your PIN number. They're going to start draining your account. So what are the good practices to take care of that seed phrase? Obviously, don't tell it to anybody. You can try to remember it by heart. That's the safest. So if you can over time remember 24 words, that would be the safest. Otherwise, you have to either write it down somewhere, store it in some sort of physical form factor and put it on a safe somewhere, or I don't know, dig it somewhere in the bushes. The other way you can go about it is perhaps splitting that seed phrase into pieces. Let's say it's 24 words. You can split it in like 3. So that if somebody got a hold of one of those pieces, it's not enough to create the whole private key. So I don't know, 8, 8, and 8 words, and you put them in different locations, and that's secure. So you don't have to memorize them, but you just need to have access to all 3 locations, for example. And there are some devices I saw online where like a metal sheet which provided with letters enough for you to create those 24 words, and that closes up like a case, and then there is some sort of lock on it. So let's say you can keep that at your place, and even in places on fire or flooded, it's still intact. Because default, I think, is to write it down on some sort of piece of paper, like a notebook. In case of fire, it's going to burn, and then if you don't remember it by heart, then it's a problem. That said, you only need that seed phrase if you need to restore connection to your address. If you don't need to restore connection, you're never going to use that seed phrase again. But you probably will, because you upgrade your phones every couple years, and you might drop it somewhere, or you want to have access in multiple devices, for example, on the phone, on the tablet, on the computer, on work tablet, and so forth. So once you establish connections to your address, you don't really need your seed phrase unless there is new need to create that connection. Another way to go about it is also you can have multiple addresses, right? Let's say you use one as your main one is more like disposable one for like daily use. So put like 90% of your funds on one address and 10 on the other address. Have that small chunk of money on your mobile wallet, and then have most of it on that offline version, like a piece of paper. And so it's not even have a software presence. So it's somewhere out there in the cloud, but there is no device that connected to it. It just, the seed phrase is stored somewhere that you can create the connection on demand when you need it. So that's could be also one of the safest way. Because think about it, is it's about how can you be compromised? And usually in digital world is about some sort of malware, viruses gets on your devices, or someone connects to your machine remotely and reads what you type in, or your webcam, or your files on your computer. Or if you store it somewhere in the cloud, email, all of those can be hacked and are hacked periodically. And because crypto becomes so popular, they will specifically look for seed phrases or analyze anything that can look like a seed phrase and then try to use it. Therefore, knowing this, then we need to act accordingly. Anything that pops in your head as far as questions or any other topics?
Not right now. I know I need to do that. What else?
So right now, somewhere on your device, that private key is sitting. And hypothetically, if there is access from the outside to your device, it can be taken. I'm saying right now is a low risk, but philosophically speaking, that's how it works. If there is access to my device from outside, that key can be copied, taken out, and funds can be drained.
So even like the pricing, like it says Bitcoin price, and it's like a big number, 26,914. Like, what does that mean?
That means on a global market, on exchange, if you want to buy one coin, you have to pay that much money. Think about it as a stock price, right? If you want to buy one share of Microsoft, let's say it's like $70. So same goes here. One coin of BTC costs, as you said right now, 26,800, and that price fluctuates every second. So that comes to this idea of, if you want to make in dollar terms profits from holding any kind of crypto, the idea is that the price per coin going to increase. That's how you make money in dollar terms. So if tomorrow it's going to be 30,000, then you make $4,000 as a difference between now and then. And the way to increase your exposure, it's either buy more coins or put some sort of leverage position, because some platforms allows you to own more than you can afford. Margin accounts, right? So let's say it's kind of similar to buying a house or mortgage. You only have 10%, but then there is entity that can say, don't worry about it, we'll pay for the entire house, but you owe us 90% plus interest. So that's kind of what margin accounts are. So if you want to buy 100 Bitcoins, but you only have money for one, these platforms allow you to have that leverage. And as long as you have enough collateral, you can hold your position. So how much of real money you have put in, they track it depending on the price. And if you're positive, then it's great. If you become zero, they close your position and you lose your funds. I mean, you lost it because of the market price change. Yeah, and start thinking about like global investment thesis. What do you think the world would look like in 5-10 years? Which technologies? What's going to happen with our banks, governments, countries? That's kind of where your bigger picture comes from. And then you can answer questions like what is secure, what is risky. Basically, every time you hold something, that's risk. Real estate is a risk, dollar is a risk, gold is a risk, car is a risk that gets even worse every day as you're driving it. At least some of it can have utility, right? You can live in a house and drive a car, but some of these securities are really not usable. It's more like a promise of some sort that it's gonna go up in value or that somebody's gonna pay you some interest on it. So you can start off also by creating Twitter account, or if you already have one, to start following those people and see in real time what the world looks like and how it changes. And also a lot of these people provide good commentary on events. So then you can basically learn from them how they think or what they think specifically about specific events that take place. And you become more experienced, educated, and that's good.
And I guess we talk about like buying different types of tokens, right?
Mhm.
And then not just sticking to one.
Or that's where you need to think about your thesis, right? What do you think is going to happen? What I told you last time is that at least you can derive some clues from history if you had history and the ranking of those coins. So if you think that some of them sticked around for a long time and they never really lost their position in top 10, top 20, that suggests that there is underlying interest from market participants to keep them up high. Meaning every time there is a drop, there is a chance it can drop to zero, or it drops to level that is above zero enough over a long period of time so it never really became zero. That means there was somebody over a course of long period of time who were sufficiently interested to hold it and take a risk so that it's not zero yet, right? And as long a history we have about of that type of action by market, that means we have more assurance that it's probably going to be continue to be the case that there are interested people in this. For example, Microsoft stock, right? Over the course of 30 years, it didn't drop to zero. That means that's at least some sort of protection from risk. At least we know it's probably not going to fall to zero anytime soon. Maybe 50 years from now, it would be no Microsoft, but at least next 2 years, most likely it's not going to be zero. That's, I guess, the worst scenario. If you want to be more optimistic, then it become more complicated how to predict price appreciating, for example. But with regards to which coins to choose, yeah, if in 5-10 years they didn't disappear from top 10, that means somebody kept them afloat. The cumulative buyer of the market kept them afloat. There were enough buying interest to keep it up. That's kind of how I look at it. So I tend to not look at anything out of top 20 and only look at those that have been in top 20 for like 5-10 years. And once those start to look interesting, then I'm start to get interested in exposure to those coins. But I usually don't get excited about something that just flew into top 20, been there for months, and is getting a lot of attention online. And I usually stay away from that.
So what's usually, I guess, your behavior? Okay, so let's say I'm gonna buy two types of coins. Do I
Mhm.
just leave those coins there and just watch how either they go up, they go down, kind of forget about it, or you have to be like Like how often do you check them? When do you have to decide, I guess, if you trade them for a different token, or I mean, I just don't know what's the right behavior.
Well, for one, you mentioned out there. The out there could be exchange or your self-custody wallet. That's the first question, right? So we talked about keeping on exchange as a risk. Holding it on your own wallet is less of the risk. So that's number one. So I would suggest to hold it on personal wallet. Two, how often to look at it. I think it derived to your, I guess, time horizon. If you planning to hold, let's say, BTC for next 10 years, you don't even have to look at it because you already know you're not gonna do any moves. But if you're more like a speculator mindset, and if you think, well, if it goes up by like 50% in short amount of time, it's good for me to sell because it's probably gonna go back down, and I don't want to lose that profit margin. So that by itself means you're gonna have to be more attentive to your position and more plugged into day-to-day price movements. But if you want to be focused mostly on your normal day-to-day life and spend less time at the screen, and you don't have to become a trader, right? Because looking at it frequently means you have to develop some sort of skills of a trader, successful trader, because you're going to be in and out, exchanging to different coins or talking about stocks, different stocks. And that's by itself means you need to have a skill. Where if you think in long-term horizons, you don't need to have a skill of trader. You just need to have a bias of the future projections. You literally just open position and hold it for a long time. So there's no trader skill involved. It's more like philosophy about the money appreciation of some sort.
So I guess what would be the smart thing to do if the main goal is to make money?
Yeah.
Do we just leave it there knowing my timeline it's 10 years? Or should I try to like gain the skills to become a trader? Is that just like optional?
Now,
Like
skill, I'd say it's not feasible for you. So think about skill of a trader as, let's say you want to be in medical field as a surgeon. Like, what's the chance you're going to become surgeon fast? Like zero. So I would say trader is very similar as far as sophistication. Uh, I would not even think that you can become a trader like the ones who make money on frequent basis doing trades for living.
just okay.
That's out of your reach.
Hmm.
Speaking about, I guess, position in life and how much energy time you have. So being realistic, you're just saying it's not my option. Therefore, you're just trying to catch larger trends. Like, for example, what happened to real estate in the next 5 to 10 years? What happens to gold in the next 5 to 10 years? So more like philosophical bets, binary bets. Are they going to up or down, given my perception of reality or in the future, rather than day-to-day volatility, news developments, and things like that. Because if your horizon is long enough, these daily news on Twitter doesn't matter whatsoever. If you believe in your philosophy that's going to go up, for example. I mean, obviously, you're going to develop it based on news and your perception and observations from the world around you. But I'm talking about minor news, like, hey, this and this exchange hack happened. Like, who cares about it if BTC gonna be, I don't know, 5 times higher 10 years from now? Nobody gonna remember this hack of this exchange ever. Months later, nobody gonna remember it. So it doesn't matter for your time horizon. And for these large time horizons, you don't have to be a trader as far as execution of trades. You just need to be able to open position and close position at some point later. As far as what's your exit criteria from your trade, right? It can be simply time-based, like let's say, I don't know, 10 years from now, you just want your cash back, whatever the amount is, like very hardcore timeline. Or you say, well, I hope I can double or triple or tenfold this thing, and I'm going to get out once I do reach my target. Because you can be like that. Or for example, if Ethereum reaches 10,000, I'm going to get out regardless how much time it takes. Let's say right now Ethereum is like, roughly speaking, 2,000. So 5-fold from now, I'm just going to take my money and I don't know, retire or focus on something else. And so yeah, there is no trader's skill involved in that thinking or in that model of execution. And your horizon, your profit taking is very specific, either by time or by exit criteria of some sort of price, or maybe even news driven. Once you see a lot of hype about specific industry or coin, then you probably know it's time to get out. But again, it's about your expectations. If you have this hype happening tomorrow and you only have like 5% gain, then it's roughly speaking where you started. So maybe it's not the reason for you to get out. Or maybe you're so late in the game that it's probably not gonna go and you go higher because you have bad sign of continuous of the trend. Like whenever you see a lot of hype, that's usually the end of the move. And I mean, so you understand the hype can be different intensity, right? Like minor, like a week or two in the news, somebody talks about Ethereum, for example. Or it could be like months long pump on Twitter and everywhere, everybody just talking about it. You get on a Lyft, Uber drivers talking about it. Oh, that's a big hype. And those are usually the signals of the top. So I know, for example, my experience of that. When I was working consulting in one of the clients of mine, I would go to cafeteria, just get a coffee, and I would have like 10, 15, 20 people, engineers talking about Ethereum ICOs. I'm like, don't you supposed to write code right now? Aren't you supposed to talk about bugs and tickets and so forth? So that gave me clue that that's probably top of the market. Like it's very classical example. If you read books about trading and about investments, you would come across this type of ideas that whenever you have average non-professional individuals, non-traders talking about stocks or any kind of financial instruments, that usually it's speculative bubble at the very top and it's time to get out.
So what might, because I think that's what happened a couple of years ago.
Mm,
It was just, I mean, everyone was talking about it.
exactly. Yeah, you're right. That's exactly what happened. Like
So
I
what made,
remember examples like I think Paris Hilton was talking like NFT is the future, and then it was NFT sold left and right, some garbage crap, like something that I can do like in 30 seconds, people would sell for like thousands of dollars. So yeah, that was definitely a hype example. And yeah, that's true. I mean, we see what happened a year or two from now. From that moment, we're down like 80%. So that's clear examples of the hype or euphoria correlation to the top of the market. So then whenever you talk about your timeline, sure, you can have like hypothetical 10 years from now, but then if this type of event happens within your timeline, you don't want to sit back down 80% price going down. You want to take your money and probably go away. It depends on your profit expectations, I guess. If you want to over, how to say, sit over that downturn, so let's say you have 10 years time frame and then you see the euphoria and then comes back, but you know you're still going to be sitting for 5 years because that's your hypothesis, then you can sit over that thing, and if it rises again and goes even higher, then it's kind of within your plan. But if it goes too fast and then you have euphoria signals, well, maybe it's good enough for you not to even think about 10 years anymore and just call it a day, and that's your trade. One thing also to think about, whenever you exit from your position, whether it's real estate, crypto, stocks, what have you, you're going to have a problem because now you don't know what to do with cash, right? Because you have another thought milestone. You need to think what's next. And a lot of times it's as tough as first time. And a lot of times that's the reason not to get out from your trade, because you're going to end up again in decision making. And sometimes it will be tough. So exit is kind of first euphoria at the market, and 2, there are opportunities, or soon will be opportunities, to plug in your capital somewhere else that would start to enjoy reversal from the bottom to the top, right? So for example, let's say stock market is high, but then you see the commodities are very cheap, which is the case, by the way, last couple of years. We had the S&P going to like 4,500, I believe. But then we had something like oil, sugar, I don't know, any kind of crops were very cheap. And we about to see the rally in commodities. So then you take out your money from a stock market and buy futures of, I don't know, grains of some sort. So then one was going up, then you took it, you cashed it out, then something else started to go up. Basically, your job is to catch waves, either transformative waves like new technology, or movements in sectors or different asset classes. So then you have to be, that's kind of this big mindset of investor. You need to be constant lookout what is going up, what is going down, and what's the kind of relationship between them, so that you can develop this idea of hopping over from one to another over a period of time. So it will be bubbles in specific asset classes. That's just how it works. So in preparation for next bubble, you need to already start develop where you're going to jump to from this bubble top. I mean, as much as skillful can you be, but you're trying to get out somewhere close to the top and pick something close to the bottom, or something that is not that high yet. So you're constantly on lookout where to plug in your capital once you exit this current trade. So that's kind of the gist of investment in a big picture. What is cheap, what is expensive, basically. So let's look at right now asset classes. Is housing cheap? No.
No,
Is gold cheap? No.
I don't think so. I haven't checked.
Is oil cheap?
No.
Is oil cheap? Somewhere in
No.
the middle, I guess. Is dollar cheap? Again, somewhere in the middle. Is crypto cheap? Yes, it is cheap. Is commodities cheap? Some of them are not. So that's kind of how you analyze, and then you create kind of your watch list that you're gonna start try to find an entry point once you have cash or multiple positions, right? You're still in that trade, but you have ability to deploy more cash towards something that's gonna start new wave. So basically, it's a surfing waves. That's what investing is. And then people do it via sectors, like some only focus on technology, right? I'm going to buy Facebook wave. I'm going to buy Google wave. I'm going to buy ChatGPT wave. I'm going to buy, I don't know, something else. And some focus only on commodities. I'm going to buy oil wave. I'm going to buy orange juice wave. I'm going to buy corn wave. And some people mash these boundaries and they hop around everywhere. I'm going to ride crypto wave. I'm going to ride stock market wave. I'm going to ride dollar index appreciation wave, and so forth. So yeah, it's about surfing basically. So romantic, so melodic. Compare investments to surfing. I told one of my friends that it's also kind of the management of portfolio. It's kind of jump in the river of stones, right? You have a path like a small creek or river, and there are stones that you can use to hop to another side. That's kind of what investing is, or managing your funds. You need to see which stone is more appropriate for moving towards your goal. And in case of our investing is buy cheap, sell high. So if it's cheap, it becomes interesting. If it's expensive, it becomes your exit candidate. So we talked about, should we invest in various coins or should we stick to one? So where you stand right now, what's your thinking?
I think I'm gonna stick to two.
You don't have to talk about specific ones, but why two rather than one?
Like just to have like a wider, how do you say it? Like I know the word is
Broader,
not luck, but
broader coverage.
Yes, broader. I was saying wider.
So basically, you wanna take advantage of more broader market raise. It's called like a tide go up, right? So there's a term like tide lift all the boats. So the boats are instruments, and if the general tide goes up, all the boats go up. So if you basically, instead of betting on one boat, you're saying like, I'm just gonna buy a couple to get more averaged increase, right? But that's something that you have to study, because that's your hypothesis that they all gonna rise kind of in specific way, and you're trying to get the average, for example. That might be wrong. It might be just one rise and the other fall into zero,
Mhm.
and so forth. So to get more, I guess, comfort with your position, because that's important. That's something we haven't talked about. It's important to be comfortable with your position, so that whenever there is volatility coming tomorrow, day after tomorrow, you don't think and sit and judge like, oh my God, maybe I should get out. Oh my God, I made a mistake. So to derive to conclusion that you made a mistake, it's by itself a decision process, thought process, right? So you have to have some sort of notion of correctness, and then mistake is a delta between that correctness and what you have in reality. Because a lot of time people say, oh, I should have bought later, I should have bought lower, I should have not bought, I knew this would happen. My question, like, those all are empirical judgments. Like, you have no foundation to think you would be right otherwise, right? So in this case, yes, you have the type of exposure you want to receive to any kind of market, and then you see which instrument going to give you that exposure, right? So it sounds like you want to have kind of more broader diversified exposure to crypto in general, rather than you betting on a specific protocol coin.
Yes.
So then you can also look at something like I think Coinbase have an index that tracks the entire industry. I don't think they have a product that you can buy that tracks the whole thing, but just something for your kind of general knowledge purpose. I think Coinbase have some sort of index that they created, like, which tracks like 30 coins or something like that. So that would give you kind of broader trajectory history, and then you can probably compare your specific candidates versus that index performance and see how they perform over time. But yeah, I mean, that's somewhat, how you say, appropriate thinking when you say, hey, here's my philosophy, I want to have broad exposure, that's why I'm going to buy 2 tokens, for example. It's not the type of thinking where, well, I don't know anything, I'm just going to buy number 5, or like, there is thinking behind it, there is a game plan behind it, you know, your exit criteria and so forth. So that's already kind of a glimpse of the plan. A lot of people don't have any plan. They just say, I heard crypto is making money, boom, put 5 grand, boom, lost everything. So yeah, it's somehow, yeah, people forget that it's not like it's everybody is winning the game. Most likely everybody gonna lose type of game. So I have to take it very seriously.